In addition to covering the latest stock market charts, in this week's video, we'll take a look at retirement, the 4% distribution rule, pie chart investing, drawdowns and time versus risk management. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This week we're going to expand on last week's topic where we talk about frustrating markets versus the concept of going back to buy and hold. The 4% rule, if you don't know it, you can pause your video player down here in the lower left-hand corner and read this. Before we expand on the topic, just to refresh your memory, last week we talked about frustration when you have sideways markets like we have had in 2015, and how the whipsaws when you're managing risk can be a drag on performance, and we compared how difficult is it to make up your whipsaw insurance relative to bear market losses. Longtime viewers and clients may remember the analysis that we did with the quintessential equity portfolio mix. The point was you could use up to 10 ETFs or mutual funds. And we didn't pick this portfolio. It was presented as the quintessential way to grow your money, providing diversification. It's the best method based on 45 years of research and experience. And it was supposed to provide diversification relative to the S&P 500. And if you'll remember, our objective was not to say buy and hold doesn't work or to say anything negative about any other strategy. We were just highlighting how much real-world diversification does a mix of ETFs or mutual funds provide in a crisis or bear market. And you'll remember we termed this pie chart investing. It's logical to ask yourself, should I just go back to buy and hold pie chart investing after a frustrating whipsaw-filled year similar to 2015? And that's a fair question. This was the portfolio that we covered in the past. And again, our objective here is not to say buy and hold doesn't work. In fact, we're going to prove that buy and hold does work in this video. And those who watch that video remember that the diversified portfolio in the real world in the financial crisis bear market actually underperformed a buy and hold SPY or the S&P 500. The next logical question is there another concern related to drawdowns and retirement? The answer is yes, and we want to give credit where credit is due. The suggestion for this analysis was forwarded to us by one of our clients, and our response to the client was that we were fortunate and blessed to work with some incredibly intelligent clients. The example that we're going to cover and how we're going to expand on this topic, let's assume that we have $1 million when a bear market starts. It doesn't matter how we get the $1 million. We could have won the lottery. The $1 million could have been accrued by investing for our whole life. The math works the same way. It doesn't matter how you get to the peak. If you have $1 million at the peak, the math is the same in all instances. We're going to assume that we're retired and we're taking monthly distributions based on the 4% rule of thumb. It basically says that we don't want to draw out any more than 4% of our portfolio over a given calendar year. So in our example here, we're going to take 4% of $1 million and we're going to withdraw it monthly at the end of the month. We will recalculate our 4% annual distribution at the end of every calendar year to make sure that we're not violating the 4% rule and drawing too much from our portfolio. We just showed that buy and hold SPY actually outperformed the diversified pie chart of 10 different ETFs or mutual funds. Therefore, we're just going to use SPY because, frankly, in the last bear market, it outperformed and wasn't much different than a diversified pie chart. The analysis includes dividends for SPY, and it includes the fees. Our objective here is to see how a bear market impacts our monthly income using the 4% rule, and how long does it take us to get back to break even. So buy and hold works, but how long does it take to work? In the case of the financial crisis, the answer was it took 6.33 years, or an astonishing 2,312 calendar days to get back to break even. And we did it in an incredibly realistic scenario. We took the daily prices for SPY, so we're compounding daily just like a regular portfolio would, and then we're taking the monthly distributions out of the portfolio and calculating how long it took to get back to break even. If I had $1 million, and I can't emphasize enough, it doesn't matter how you get here. If this graph goes back 50 years, and it took me 50 years of investing to accrue $1 million, the math is exactly the same no matter how I accrued the $1 million. So if I have $1 million when a bear market starts, here's my drawdown, and then it takes me this long all the way from 2007, in October of 2007, all the way into the early stages of 2014 to eventually move back above $1 million and stay there. During this entire period, inflation is rising and our income is falling. How can our income be falling? Remember, to properly implement the 4% rule, you can't take out more than 4% of your portfolio in every given year. Meaning, as we go through this analysis, when we start at the beginning and we take 4% of $1 million and divide it by 12, our monthly income at this stage is $3,333. When the new calendar year comes, I have to recalculate that because my portfolio has dropped. My monthly income drops to basically $3,100. The worst case for one full calendar year, when my portfolio drops below $575,000 in early 2009, my 4% rule says that my income has to drop 44% in order not to violate the 4% rule for that calendar year. And this is what the monthly income looks like. This is where we trough. So things start to improve after this date here, and my monthly income does start to go back up. However, in 2010, I'm still dealing with a 32% monthly drop in terms of my monthly income relative to where we started back in 2007. Then we go to a 24% drop, a 26% drop, a 17% drop, and then finally, in calendar year 2014, we get a raise of roughly 5%, because now when we went into this calendar year, we were calculating our 4% on a portfolio that was back above $1 million momentarily. It drops back below on February 5th, 2014, and this date here represents where we get back to break even and we don't drop back below it. Therefore, from an opportunity cost perspective, buy and hold in this case absolutely, positively worked if you implemented it properly. Buy and hold requires you to grit your teeth and toss and turn at night for 2,312 calendar days. And if you're able to do that, and you're not one of the people that panic and sell out here, which is common, that's not a knock on anyone. We're all human. If I implement properly, I have to wait over 6 years for buy and hold to quote unquote work. And when you're younger, that's fine. It does work. But when you start to get older, this type of drawdown doesn't fit well with being able to sleep at night and be able to keep your income relatively steady based on your portfolio. This is why risk management is so critical and why the CCM market model focuses on the entire cycle, a bull market and a bear market. A fair counter argument might be, Chris, that is a ridiculous historical example. A bear market like the financial crisis was a once-in-a-lifetime event. Well, answer number one would be, remember, we're not assuming that you begin investing when the bear market starts. If it takes me my whole life to accrue $1 million, the math doesn't change by 1 penny based on how I got there. It doesn't matter how you get to $1 million portfolio, the math is identical. The second answer would be this, that it really isn't a ridiculous analysis. Why? Because in the real world, if we ran the analysis after the dot-com bust, it was probably worse. Why? The financial crisis bear market only lasted 517 calendar days. The dot-com bear market lasted 930 calendar days. From an opportunity cost perspective, you were in the wrong place for 930 calendar days. The magnitude of the drop in the once-in-a-lifetime financial crisis bear market was 55%. Well, it wasn't once in a lifetime. This is incredibly close. The S&P 500 dropped 49% in the dot-com bear market. And if the next bear market is 20%, 35%, 40%, whatever the number is, the math still works the same way. That buy and hold works, but it can take a long, long time for it to work. And it assumes that you have the stiff upper lip and the wherewithal and discipline not to panic and sell out near the bottom. So if we ran the same analysis in the dot-com bear market, we would be going backwards for 930 calendar days, and then we would start to move back to break even, and only then would our monthly income start to rise again after it was falling for 930 calendar days. The time value of money is extremely important, and having your capital on the wrong side of the market for 930 calendar days tells us that we can make up what may appear to be currently as unacceptable underperformance in a year where we have whipsaws. Remember last week we said if we underperform the S&P 500 by 4.5% in a given calendar year, how hard is it to make up that? It's not that difficult at all. I only have to make 4.77% back to catch up versus a straight analysis with no distributions. If I lose 55%, I have to make 125% to get back to break even. Another concept that will become abundantly clear when this post comes out, and we apologize that we had some problems with a third-party vendor and it was delayed. We still need to proof it. But when we put this on short takes in the next few days, and you can Google this title to find it, you will see two things. One, it is extremely common for the market to be frustrating when the Fed is getting ready to start a new rate hike cycle. And it is extremely common if you stick to your discipline that a harder, indecisive period like this, where the 50 comes down into the 200 and we have lower lows, this is a mess, no progress from here to here, no progress from here to here. If we implement properly during the frustrating period and we don't give up, you will see that more often than not, a frustrating and difficult market is followed by an easier and more rewarding market. The slope of the 200-day is roughly flat here. Does that sound familiar? The slope of the 200-day is flat today. This is a difficult market. Then it gets easier. It's not flat. It's rising. Trendless, hard. A trend, easier. There's no such thing as an easy market. In last week's video, we showed numerous things that were concerning, but we also said there was reason for hope, and there's always two sides to the story. Last week, we showed this chart where we had a bullish breakout, and we could make an argument that we're retesting both of these bullish breakouts, actually three areas. If we fast forward and see the same chart a week later on November 20th, the area that we said we might hold, possible support, did hold. That's the good news. The concerning issues are here. The 200-day moving average is still basically flat. It's actually mathematically turning back up. But you can see right here, for the most part, we have a flattish look, which tells us nothing definitive has been resolved yet. And we also have a lower high here still relative to these highs, and a lower high here relative to these highs. So obviously, we would feel better if we can clear this level and go on to make a new high. While I'm thinking of it, it's quite possible that we go on to make new highs. And if things don't improve from a conviction perspective, we could move up into this area here and not stay up there that long. So we have to keep an open mind about all scenarios all the time. 100% maximum flexibility. After we review all these charts, the moral of the story is going to be that we have some good things happening and some discernible and noticeable improvement in the evidence over the past 5 trading sessions, but we also have that flat 200-day and some other hurdles that we need to cross before redeploying any more capital. NASDAQ weekly slope of the 50-week moving average is bullish and up. We've recaptured it, we retested it, and we've also gone on now to recapture these weekly levels, and weekly momentum looks better than it did a week ago. Now let's look at the NASDAQ from somewhat of a glass half empty perspective. Resistance, resistance, a gap up and a bullish breakout, a failed breakout, which typically isn't good. It's also possible now that we fail here again. This line has meant something for some time. We would feel better if we can close above it, exceed these highs, and then go on to make new highs. If we look at the Dow daily as of the close on Friday, November 20th, it is also a mixed bag. The good news is we recaptured this breakout line here, which is significant. This is the downtrend from the spring. We're back above it. That's the good news. The concern is that's not a particularly exciting looking candlestick. This wick here tells us that we gave back a lot of the gains on Friday, and we'd also like to see this hurdle cleared as well. All of these charts tell us the short-term bias remains up, but we have to keep an open mind until some of these hurdles that we're covering are cleared up. NYSE Composite Weekly, good news. We've recaptured this blue line here. Last week we closed below it. This week we closed above it. Bad news is this could act as resistance here. Good news, price above the 100-week moving average. Good news, slope of it is up. Good news, we've recaptured these levels here that have acted as support in the past. They might have acted as resistance here. The keep an open mind part of this chart is we have a lower high relative to this high and still a lower high here relative to this high. That may change, but it hasn't yet. If you're a client, you may have wondered why we didn't buy intra-week this week. It was based on the rules. A week ago Friday, we were properly allocated. All things being equal, the rules prefer to see how we close out the week. Another reason is all of these flat moving averages, these are weekly moving averages, they're flat. And the fact that we got whipsawed here and some of the conviction in the market has deteriorated. This move here does not look as convincing as this move here, which means all of that we have whipsaw rules that are coming into effect now, where we try to minimize our trading until the market proves something to us. The longer we stay above these lines, the better. That's a prove it to me. And if the slopes can turn back up, that's another prove it to me. Hasn't happened yet. Glass is half full. We reclaimed and moved back into the upper trend channel, saying that we could move above 2130 if we go back to the top of the trend channel. Glass half empty. It's a big wick on that candlestick. We had a big give back on Friday, and we still have a lower high relative to this high, and this high is lower relative to this high. That could be erased, but it hasn't been yet. This is our W or double bottom formation that we talked about literally weeks ago. There's nothing to discount the double bottom take. This is just a normal retracement right now. What do we mean by a normal retracement? This is a bullish move. It's normal to have a give back that comes back to 38.2%, 50%, or 61.8%. Right now, this looked like we were going to fail here, but now it looks like a successful retest. The longer we stay above these levels, the better. It's very easy to see the concept of a bullish breakout and a successful retest here. This line was drawn before we came back and hit this point. We had some additional tickets and orders queued up to execute before the close on Friday, and for numerous reasons, we decided to hold off and see what the market does. This is one of those reasons. This is risk on versus risk off. Resistance rejected, resistance rejected. We're back up in that area now. So it also calls for some patience to see what the resolution is on this chart. Regular viewers and clients know that the CCM market model is highly diversified on inputs, including time frames, because there's no such thing as a magical indicator or an indicator that works perfectly in all markets. This is our concerning look weekly with price below both moving averages, blue below red, and the slopes of both are down. This is an improving look with price above both moving averages, blue above red, and the slopes of both are up. This is what the same chart looked like last week on Friday, November 13th. This is not exactly a confidence-inspiring look, and you'll also remember that 18 of the 18 charts tracked by one of the submodels that are similar to this chart here, all of them were down last week as of November 13th. The year of the whipsaw continues. This is what the chart looks like a week later as of Friday, November 20th. Understanding that this is frustrating. I've been through a lot of frustrating markets in my career, and I'm extremely confident about the fact that A, frustrating markets are semi-normal when the Fed is getting ready to change policy. This year's been a little bit more difficult, but the concept of difficulty is not new, and if you continue to execute faithfully as we have, eventually the odds will shift in your favor. This week the chart looks better, and 17 of the 18 charts flipped back this week in a positive manner. We'd like to see that higher high and a higher high above here. This is an improving look. Same exact concepts, weekly charts. We're just using longer duration moving averages. Regular viewers and clients know that when we get this tight look here, we can get a big move in either direction. Notice here, price is above when it's tight, but we end up moving in the other direction. So when you get the tight look, you keep an open mind about both directions. And here, you have a tight look and we close on a weekly basis below it. Right here, your bias would probably be to the downside. We moved to the upside and got a big move in the other direction. Open mind, open mind. This is the exact same chart with the exact same moving averages as of the close on Friday, November 20th. You can see last week we had a weekly close below the tight moving averages, similar to this period here, and we reversed sharply. Tight moving averages, keep an open mind about a big move in either direction. Some things that are encouraging here. Blue is now on top. It was on the bottom here, and the slopes of all of them are up. So the bias with this chart here is to the upside, but there are some other inputs in the model that have some work to do. Remember, we still have that flat 200-day moving average, and remember, those weekly moving averages are still flat. As always, open mind going into next week. Here's the good visual. Here's the chart last week as of November 13th. We're below. The slopes are down. Fast forward a week later on November 20th. We're not below, we're above, and the slopes are up. Open mind. Remember, we said we've seen enough right now for a limited number of whipsaw rules to be in effect right now, which try to reduce whipsaws and trading frequency. We want the market to prove more to us. One of the prove it to me things is, this is the S&P 500 weekly. We have resistance right here, which comes in at 2095 and change. On a weekly chart, we have the same thing on a daily chart and the same thing on a monthly chart. This calls for patience to see what happens. This is good news, bad news. During the week, it appeared as if this week's volume was going to lag last week's volume, but that's not the case. This is a good sign. Volume picked up a little bit, and it's about the same, and in fact, it's probably a little higher than last week. It's the same basic concept on the monthly chart. The level is 2095 and change. This is a nice tool from stockcharts.com. These charts here with the pivots are not part of the market model. If it's not part of the market model, why are we looking at it? Because there are numerous things that we use that aren't part of the math in the market model, but they help us with the rules from an implementation perspective. So a chart like this can help us with the timing of trades and executions, and when to be patient and hold off and make the market prove something to us by clearing a hurdle. There's no question that it's been a frustrating year for numerous methods and systems, but that's part of the job here. Markets can be frustrating. Let's just remember, after a difficult period, typically we get an easier period. After a difficult period, sideways 50-day, we typically get an easier period with trends. After a difficult period, this is a mess. If we execute properly, we will be rewarded as trends will emerge. Difficult period, sideways 200-day, 50-day all over the place, whipsaws galore. If we execute faithfully and stick with the game plan, the odds say a big move is coming either up or down. Difficult period, 50-day kisses the 200-day. In this case, if you executed properly, eventually this and this led to a bear market. It doesn't necessarily mean the easier period will take the form of a bullish trend. This is still an easier trend to discern. It just happens to be down. As always, we know if we pay attention to the charts and execute faithfully, the math, the model, the moving averages, and the other inputs will eventually help us get in the right place. The key to success in difficult periods is consistent implementation. If you'd like to see more detail about the pie chart analysis, a pie chart relative to the S&P 500, you can Google this title here and find the video that was published on June 5th, 2015. If you'd like more detail on the whipsaws versus bear market losses analysis, you can Google this title here and find the video that was published on November 13th, 2015. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.